On this week's Wealth Track, in an exclusive interview, great investor Charlie Dreifus explains why he thinks the stock market is priced to perfection and why we should be de-risking our portfolios. Royce Special Equity Fund's Charlie Dreifus is next on Consuelo Mack Wealth Track. How do you explain the recovery, the resurgence, the renaissance that's occurred in small cap stocks? Why is this happening now?
Well, it has to do in part of the uniqueness, even pre-election, but certainly post-election, having to do with U.S.-centric businesses. There are a lot of concerns about what's going on, let alone with our neighbors, but around the world. A lot of the tax talk in terms of the new administration, in terms of tax reform,
right, tax cuts.
Tax cuts would benefit companies with high tax rates. The companies that have high tax rates are domestic.
Right.
They haven't taken advantage of the lower offshore tax rates. Small caps benefit by that.
Also, the rollback in regulations, if that occurs, that's going to help small businesses. I'll say that my number one issue is regulation.
Regulation, Obamacare, all these kinds of things which had been highlighted by small companies as being headwinds become less so. And to the extent that the U.S. economy improves, companies that are U.S.-centric rather than multinational benefit the most.
Right.
So there's been a resurgence in small cap, although the entire market in 2016 was very broad and advanced.
Now what? As a value manager with the Special Equity Fund investing in small cap stocks, how do the values in small caps look at this point?
Not too inviting.
They're expensive.
Is that expensive, right? Yeah. Valuations are high. Valuations were high going into the election already. Post the election, the market has advanced, record highs on the indices, and yet interest rates rose. So if you go back to my buying a company as a business, if I have to pay more for the business, I'm going to earn less as a return.
Right.
And yet when I finance it, I'm going to have to pay more to borrow the money. So the market is even less attractive now than it was before the election. And the market, in my opinion, is priced to perfection. So this can get resolved, in my opinion, two ways. Time. The market does nothing for a period of time, whether that's a year or two. If the market goes flat and in fact the economy improves, then earnings catch up to valuation. Valuations decline, things become much more attractive. The other way that it corrects, which is less pleasant, is a big decline.
Right, big correction.
A big correction, which could happen, for any reason, a black swan reason, God forbid, terrorism, all kinds of things can happen.
Therefore, what are you doing with the Special Equity Fund? How are you positioning it, possibly expecting some sort of possible event?
People give me the money in special equity to invest. So I don't market time. The cash is a residual. But having said that, the market influences the residual. If the names available to invest in, if I can't find anything to invest in, and the names that I already have populated in the portfolio become more expensive, I sell the ones that are expensive, and I'm not replacing it with anything new.
Right.
So cash as a percentage of the portfolio rises. So it's not a direct market call. It's not a macro market call. But it's a bottom-up market call, which I think is even more important. When you can't find merchandise, if you have a discipline that has worked for many years and there are no new opportunities, don't force it. Don't do something that is not part of the discipline, because the discipline works over time.